Hi, I'd like to give you a little background on our current strategy at City Different Investments with regards to fixed income investing. We think it's an excellent time to begin investing in fixed income securities. The main reasons are that the irrational exuberance exhibited by the fixed income markets in December when they anticipated 6 to 7 Fed rate cuts in 2024, when the Fed only commented on 3 possible cuts after their December meeting, seemed to be a little of an overreaction. Within the last 2 weeks, that view has changed dramatically. And with the addition of some Fed commentary, so that any rate cuts in 2024 are now in question. And that was confirmed today by Chairman Powell's comments that because of the inflation measures we have seen recently, that the Fed is going to take more time before it begins to cut rates. It wants to see the market move lower in terms of inflation from 2.8% on core PCE down to their 2% target. So if we think that's the case, why do we think it's a good time to invest in fixed income securities? Well, let's do the math. If you look at the yield curve, it is inverted. And especially in the front end of the curve, you are getting compensated versus inflation to invest in fixed income securities. Inflation is the major foe of the fixed income investor because it eats away at your purchasing power. Now let's take a look at the yield curve. It's inverted. So Fed funds rate is running about 5.33%, okay? Inflation's running at 2.8% as of the last core PCE reading. That gives you a real rate of an excess of 200 basis points over the long-term average real Fed funds rate of 53 basis points. Very attractive, except the problem is the cash trap. You only have that rate for a very short period of time. We don't know what the future holds, and that rate could drop precipitously if the Fed begins to reduce short-term interest rates. Let's look at the 5-year range of the curve. Well, you can get about a 465 there, okay? Not quite what you're getting on a money market fund, but you keep it for 5 years. Now, if we go out to 10 years and longer, the math gets a little more sketchy. Think of it this way. A 5-year yield on a Treasury security is 465. A 10-year yield on a Treasury security is about a 465. The maturity or duration difference, which is a measure of price sensitivity, it means that the 5-year security is 55% less volatile than the 10-year security, and you're getting paid the same income. A great relative value decision. As we go further out the yield curve, because the yield curve is inverted, longer maturity securities are not as attractive relative to that 5-year range. So how are we inputting these views into our strategies? Well, we're focusing on the 1 to 5 year range in all of our SMA accounts. Short term without saying, limited term, and our intermediate term strategies. Why are we doing that? Because we don't believe we're getting paid to take risks to go much further out. That doesn't mean we are leaving longer maturities in the investment universes of the relative accounts empty. What we're doing is we're underweighting them by half and overweighting the front end of the curve. That way, if short-term rates begin to drop, we'll be able to take the capital gains from those securities and deploy them further out on the curve at better relative income levels. And that's how we manage our funds. We look at it on a total return basis. We want to get paid to take risk, and if we're not getting paid to take it, we'll take less of it. And that's the environment we're in.